Good morning from our global headquarters in New York. I'm Menace Grenny. You're welcome to Bloomberg Brief. Let's set that agenda. Caution ahead of the last piece of the jobs jigsaw for 2024, guiding the Fed's rate cut options. President-elect Trump picks David Sachs as his AI and crypto czar, and former Senator David Perdue as ambassador to China. And don't miss our conversation with the new German Finance Minister, Jörg Kukies. That's later this hour. Good morning. An abundance of caution ahead of the jobs report. The whisper number on the Bloomberg terminal this morning, 220,000, bang in line with the estimate of 220. What would be a blowout number is the question you need to ask yourself after all of the revisions. Bank of America warned there is froth building in these markets. There's a risk of an overshoot in early 2025, but you still could get to 6,666, which is 10% above here, before you probably need to worry. The bond market is ground zero for the jobs report. In actual fact, all these risk markets will be focused on the jobs report, but we are focused on the average hourly earnings, 3.9%. The rates market right now sees a 65% probability of a further rate cut in December, and just 80 basis points for 2025. Veronica Clark will join us a little bit later on from Citi on her outlook for the rates market. We're also keeping an eye on HP Enterprise this morning. They reported better than expected revenue, all as a result, you got it, of their AI servers. Another earnings story, Lululemon raises its full-year outlook due to strong sales overseas despite slower growth in consumer spending. And Boeing falling after the federal judge rejected its plea, the plea deal that would have allowed the company to avoid criminal prosecution over two fatal 737 MAX crashes. Those are just three stocks that are on the block this morning. In just a few moments, we'll be speaking to Henry Allen of Deutsche Bank. And a little bit later this hour, we've got Citi's Veronica Clark. Of course, the strategists there have a very different view to the economists. We'll ask Veronica why she's hunkering down again on a slowdown in this US economy. The team at Deutsche Bank today are pushing ahead with a payrolls report saying this. Following the weather and strike-related disruptions from the previous month, the underlying trend in the US remains very positive, and we think that momentum will continue into 2025. Henry Allen is the macro strategist over at Deutsche Bank. And this is a paraphrase, really, of what Powell said. This economy in the United States, it is the envy of the world. For you this morning, what would be a solid bounce back, reaffirming that envy of the world position for the USA?
Well, I think if you got a solid number, say non-farm payrolls came in above 200,000, then that would affirm that the number that last month, only 12,000, the lowest since December 2020, was likely just a blip. And there are reasons that we can explain that. So obviously we had the strike-related disruption, particularly from Boeing. We also had Hurricane Milton barrel into Florida during the week of the survey. So there are rational reasons why that report would have been lower and didn't speak to underlying weakness in the economy. So as long as we get a jobs report above 200K, we're saying 215 is our baseline, then we're pretty positive for what that means going forward.
So that's a nice bullish sort of consensus number in there. I mean, the estimate on the Bloomberg is 220, the whisper is 220. These asset markets are on fire. There's an exuberance in equities, in crypto, and there's a stoicism to the bond market. But does that reflect in the economy? This economy is strong. How strong do you think it can persist into 2025? And how dependent is that on, let's say, on an aggressive tax-cutting policy from the president-elect?
I don't think it is dependent on that, because actually there are a lot of positive tailwinds as we look forward into 2025. In particular, the Fed, of course, are now easing policy rather than hiking rates. And we know that monetary policy operates with a lag, so we should get the tailwinds from that into 2025. And to some extent, the tax cuts are already priced in, because at the end of the day, it was widely expected that both sides, Republicans and Democrats, said they wanted to extend the bulk of the Trump tax cuts beyond 2025. So I don't think that's going to be a significant macro factor. Clearly, there's then a risk from any tariff policy, but we'll have to wait and see where that lands out. But fundamentally, I think the trends are pretty positive into next year.
Look, one of the tails, and it's getting fatter because we'll know a little bit more about it, is the possibility of tariffs, Henry, and whether President-elect comes out on day one and goes hard and heavy on China. He's already indicated 25% for Mexico and Canada, whether we reach that or not. But the risk is this, the tail risk is this. And I want to know the differentiation between a reinflation spike on a policy narrative from the next Trump administration or the risk of stagflation.
I think the risk is that you get what we've dubbed actually growthflation. So you get, rather than stagflation, where you have low growth and high inflation, actually that growth is strong and inflation kind of persists. You get that kind of no landing scenario we were talking about earlier in the year, because growth is still running very, very positively. Indeed, the Atlanta Fed's GDP tracker for Q4 still pointing to an annualized rate of 3.2%. But then actually you've got lots of inflationary force at the same time. You've got tariffs, you've got fiscal stimulus from the Trump tax cuts, and then of course central banks are cutting rates, and we know that the money supply growth is already picking up. So I think actually what we've dubbed growthflation is the bigger risk heading into 2025 rather than stagflation. I think to get back to a stagflation type scenario, you'd need to see some sort of negative shock, perhaps geopolitical of some kind, a bit like we saw in 2022. I'd be surprised at this point, given just how strong growth is running, if you did end up in a stagflation type scenario.
So with growthflation, what does that do to the bond market? Is that what takes you to 475?
Absolutely. I mean, we think that the bond market is being too aggressive in pricing rate cuts from the Fed because they're underestimating how strong the economy could prove into next year. I mean, one thing I've been saying is for the last 3 years in a row, 2022, 23, 24, bond markets and investors have persistently underestimated how hawkish the Fed are going to be. I think they're too anchored by the low rates world of the 2010s. And actually, we're in a bit of a new normal now. So I think, as you've seen this year, as growth holds up, if inflation lingers above target in particular, core PCE came in at a 7-month high last month, and I think you could see yields rise further, particularly as the market realizes you're not going to get those aggressive rate cuts that are priced in.
What does that do to risk? I mean, we've weathered the fastest hiking cycle since the 1980s from the Federal Reserve, really quite stoically as far as assets are concerned. At 475, it's not that much of a dislocation, is it?
I don't think it is. I guess the question is, how does that balance against all the other factors? I mean, we're quite bullish in the sense that, we can still see a run-up in equities alongside yields moving higher, particularly if growth surprises on the upside, which we think it will. We're a bit more bullish than consensus on growth. So I don't think there's a big dislocation. I just think there's something that needs to be worked out in terms of markets perhaps underestimating the underlying strength in the economy. I think some of that hard landing narrative from last year is still persisting a bit. I think there's still questions as to whether those lags from tighter policy, QT still going, might impact into next year. But I think fundamentally the narrative remains a pretty bullish one. And although valuations are stretched, certainly things are expensive in the US. We've seen this carry on, for instance, in the dot-com bubble. When valuations got to this level, it still went on for a couple more years. There's nothing inevitable about kind of some sort of big correction on the horizon. No, in actual fact, that might be a bit cathartic. And that's the point that Bank of America made this morning. They looked at the price to book value in 2000 on the S&P 500, which is at 5.5. We're at 5.3 at the moment, so there's still a little bit of fuel left in the risk tank. Henry, thank you so much. Henry Allen there of Deutsche Bank on this jobs day. Other stories trending on your Bloomberg terminal is what we got for you. China has set out to extend its domestic laws across international borders with a ban on selling some goods to the US. The rules apply to companies and to individuals both inside and outside China, and is seen as an escalation with the US just weeks before President-elect Trump takes to office. President-elect Trump says he is selecting venture capitalist David Sachs to serve as his AI and crypto czar. A newly created position, he is expected to help spearhead the crypto industry deregulation and provide cryptocurrency advocates a direct line to the White House. South Korean President Yoon has lost the support of a key ally. It increases the chances he'll be impeached in a vote set to take place in the next few days. It's an abrupt U-turn. The head of Yoon's ruling People Power Party called for the president to be suspended from office quickly. If the impeachment motion passes, Yoon could be suspended from duty immediately. Coming up in the show, we'll shift our focus to Europe. Political turmoil keeps the markets on edge. We'll bring you Germany's new finance minister live from Berlin right here on Bloomberg Brief. Context matters. In Europe, France isn't alone in facing political turmoil. Germany is staring down an early election after its coalition collapsed. Let's cross to Berlin. Bloomberg's Oliver Krug is standing by with a special guest. Ollie, good morning.
Yeah, Yeah, that's right, man. It's because just a few hours actually after Donald Trump was elected president of the United States, the German government sort of collapsed under the great weight of its budget debate. And now, 6 weeks later, one finance minister later, we are facing the German election, facing recession, tens of thousands of job cuts, but also negotiating this new relationship with the new U.S. president in the United States. And I'm very pleased to say we're probably speaking to the best person positioned to talk about all these things, Jörg Kukies, who is the finance minister of Germany and a close Schultz advisor for a very long time. Thank you so much for joining us.
Hi, thank you for inviting me.
Yeah, so I'd like to begin with that relationship with Trump and Donald Trump. How are you imagining that relationship playing out? How are you going to approach that relationship, both as sort of finance minister, but also as the SPD sort of approaching an election?
Well, in the last Trump administration, we always had very constructive relationships with U.S. Treasury. I was the state secretary in that time when the relationship between then Finance Minister Olaf Scholz and Treasury Secretary Mnuchin worked out well, and they launched quite a lot of joint initiatives and had a very constructive relationship. So I'm looking forward to repeating that.
Yeah, there's been no secret, though, to the fact that his aim has been to rebalance the trading relationship in terms of flows between Germany, between Europe more broadly. Are you prepared for that? Are you prepared for tough negotiations there? Do you have a list in your drawer of potential retaliation? How do you intend to approach that?
Well, I don't think it would be appropriate to speculate. The administration isn't even in office yet, so
it's
it would be
inappropriate
to speculate about the specifics about what may or may not happen. As I said, we're very keen to engage. We're very keen to have a strong dialogue. We are in a very, very strong trade relationship with the United States. So it's obviously a very important topic for us.
And I spoke a little earlier to one of your colleagues, Jens Spahn, in the CDU, and they were talking about their approach to both Trump and China. They were suggesting that maybe there would be an opportunity to reposition a little bit away from China in a sort of striking a deal with the U.S. in order to strengthen those ties and to boost those trade flows between the U.S. and Europe. Is that an approach that you would advocate?
Well, the reality is our trade ties with the United States have grown very strongly, and we are, according to our China strategy, setting a lot of incentives to de-risk from China. We are now exporting more goods and services to France than to China. We are exporting as many goods and services to Poland as to China. So we're already seeing that this diversification, the de-risking is already taking place.
And you mentioned France. Obviously, what is going on there not have escaped your attention. There's been some concern, obviously, with yields at one point rising above sort of Greek, which is sort of seen as a very sort of strong indicator. A lot of concern around the economy. When you see that, where do you see the sort of risk, a spillover? Is it concerning you at all here in Germany?
Well, I mean, I'm obviously in very regular dialogue and contact with my French colleague, and the response of markets to the vote in the French Parliament was very constructive. There's very orderly markets, and the auction of the French OATs went very well. So in that sense, the market seems to be taking this in stride and constructively.
And another question also, we heard from Christine Lagarde also a little bit earlier this week in Brussels. And from Brussels, we've been hearing more and more calls for joint debt, specifically on the issue of defense spending, collective defense spending in Europe, and really sort of trying to build up these militaries. Is that something that you can imagine yourself and the SPD getting behind, joint debt in Europe, in order to finance the sort of great defense needs of Europe?
Well, I think there's, first of all, the question of what role will European military play in the context of our primary defense coalition, namely NATO. I mean, for us, NATO is really the big transatlantic pillar of cooperation and joint defense. And of course, strengthening Europe within NATO is a positive. But of course, before speaking about the financing, we have to talk about what does the substance of defense cooperation, industry cooperation look like. Then we can talk about the financing, but we already have quite a few projects of common European financing of defense activities, the European Defense Fund, the European Peace Facility, the European Defense Industry Program. We've encouraged the European Investment Bank to become more active in defense industry financing. So there is already a lot of work being done on common European cooperation and collaboration on defense and defense spending.
A lot of the defense executives that I speak to, though, say they don't necessarily have the sort of visibility looking forward to sort of build up the capacity to build within Europe, and that maybe front-loading some of this would be an option. There's also this discussion about maybe a special purpose vehicle so that people, member states could opt in or out to sort of issuing joint debt. Is that something, do you think, that would make it easier in the sense that it's not just a blanket Eurobond and countries could assign?
Well, I completely agree with your analysis that providing visibility to the industry to add capacity is absolutely vital. I can tell you what the German government is doing. First of all, we launched, after Russia's invasion against Ukraine, a 100 billion defense procurement fund that will do a huge amount of defense procurement and getting us to the 2% NATO target. The German government has announced that beyond this, for the years after the expiry of the 100 billion fund, we commit to at least 2% NATO spending, which is a first in many, many years. Just these weeks, my ministry has passed through to Parliament 37 projects of military procurement, some of which will last for many years to be worked on. So we are doing everything we can to give industry the clear signal that this is not something that is passing, but that this is something that is for the very long term. And in fact, we are hoping and expecting a very broad consensus on this military procurement project that we are going through and investing now before the end of the year.
And that sort of 100 billion fund that you referred to is almost exhausted. Now, could you imagine setting up another such fund off budget to try to boost spending for the years to come?
To be honest, that will be the consensus that we have is that we need to fulfill our international obligations to NATO with 2% funding. The question of how that will be implemented in the budget, of course, voters will decide on the 23rd of February, and the parties elected will then figure out what the best method is. And I have no way of predicting what that will be, but the commitment that we honor the 2% NATO target is something that has very broad consensus in the German parliament. And
a quick word on the Mercosur deal right now. Ursula von der Leyen is in Latin America. Do you expect a deal to be struck? What impact could it have on the German economy?
Well, it's hugely important, and it's very positive. The German government has for many years supported the conclusion of Mercosur and many other trade agreements by the European Union. I would name India, Indonesia. So it is part of this strategy of de-risking from China and diversifying. So from a geopolitical perspective, it would be hugely important to send this signal of cooperation to the Mercosur countries that we want to engage more and that we want to build this very large free trade area.
And just a final word on Ukraine. It's very poor timing, the election for Ukraine, given that right now anything that can get to Ukraine will put it in a more dominant position to try to negotiate potentially with Putin and Russia, with Trump coming in. Is there anything else Germany can get to Ukraine to try to improve their position?
First of all, the budgetary means that are committed in the draft budgetary proposal from the German government that was not passed in Parliament is good. It is contracted, it is committed, so this money will flow. That is absolutely independent of the interim period that we have with the temporary budget. We also, against all odds, I would say, finalized the agreement of the G7 facility of $50 billion that will be provided to Ukraine. The US has committed, the European Union, against the veto of one country, has committed. So in that sense, we finalized this 50 billion commitment. The other G7 countries have contributed their share. So Ukraine will have a very strong financing. That being said, when I talked to my Ukrainian colleague, the finance minister, he told me about the devastating effect that the attacks of Russia on civilian infrastructure, on energy infrastructure, transport infrastructure, health infrastructure, is not only having on the human lives of all those affected by this, by these attacks, but of course also on the financial stability of Ukraine, because it reduces the ability of Ukrainians to engage in economic activity, and of course it generates huge costs. So of course we are monitoring very closely and speaking with Ukraine very closely on what the macro stability needs are of the Ukrainian budget and what the military needs are. And we are fully committed to supporting Ukraine for as long as it takes.
Well, Jörg Kukies, thank you so much for your time. That was the German finance minister here speaking on an array of different issues, from the sort of difficulties of the economy here in Germany, as well as sort of the geopolitics and the question, of course, French stability, being very confident here.
Oliver, great
Thank
conversation, very broad-ranging. Oliver Cook there with the German finance minister. Snapshot for you on markets. We're on non-farm payroll watch. 220,000 is the estimate and the whisper number. The dollar, you can see this morning, up by 1/8%. We've had 9 weeks of gains out of 10. This is going to be fill or kill for the dollar, really. You know, sub 200,000 or above 300,000 will determine the direction of the dollar, according to ING. Sterling is flat at the moment. Bank of America have a huge bullish call on that. They say 138 by the end of 2025, and on euro sterling they see it getting to 80 to the euro, the strongest since the Brexit vote. Dollar yen, of course, will be a knee-jerk reaction to the non-farm payrolls, and if we get a stronger dollar, you certainly could hit 151 pretty easily. Let's talk about politics in the United States of America. The next president-elect, has chosen his ambassador for China. It is the former senator and businessman, David Perdue. He's been tapped for the role. Trump took to Truth Social saying this: he will be instrumental in implementing the strategy to maintain peace in the region and a productive working relationship with China's leaders. Kevin Whitelaw is with me. Kevin, it's interesting. This is a businessman. He's lived in Singapore. He's lived in Hong Kong. He has a firm understanding of Asian culture. The question is he a ballast, perhaps, to Navarro and Rubio?
Yeah, I mean, obviously, after Trump picked several China hardliners for other key positions, including Marco Rubio for Secretary of State, this is more of a sort of consensus choice, more of a middle ground choice. It does give someone there who has a business experience, understands how the markets work, and has operated in those areas. And remember, at heart, Trump is sort of a transactional kind of president. So he's putting someone in that role who can help be part of a transactional relationship with China, potentially, if there are things that they can agree on. I don't know that actually is necessarily going to change the overall sort of tenor of White House policy. You know, Trump historically has been someone who tends to be most influenced by the, sort of the last person in the room. And so, proximity to the White House, proximity to the Oval Office, and proximity to Mar-a-Lago are still, usually the things that actually influence policy the most when it comes to Donald Trump.
Well, when it comes to access and influence, his pick for AI and crypto czar is David Sacks. David Sacks is very close with Elon Musk. He's also very close with the PayPal team, Peter Thiel, etc. So this is a coalescing, as it were, of Silicon Valley.
Yeah, I mean, obviously, this is another position kind of like Musk's, which is not a formal part of the administration, but is more of an advisory role, sort of an outside advisor. So he's not going to be sort of a full-time person in the role, as we understand it. That means he doesn't actually have to sort of divest or step away from his venture capital fund. And when it comes to sort of crypto policy, obviously Trump has been very, very strong about wanting to promote crypto, been very excited about it. Crypto's rallied. Bitcoin's rallied like crazy on sort of what they expect from Trump. Sachs is a guy who's actually talked about wanting to regulate crypto in a pro-business kind of way, pro-crypto kind of way, but still put a legal framework around it. And so, it's going to be interesting. He doesn't come in as a full cheerleader, but he comes as somebody who seems to want to put some amount of market boundaries on it.
I like that, not as the full cheerleader. Kevin, thank you very much. That's Kevin Whitelaw on the very latest picks from the president-elect. Coming up, it is Jobs Day, in case we need to remind you. We'll push ahead with Citi's Veronica Clark in terms of her estimate. The consensus out there is 220,000. The whisper number on the Bloomberg terminal stands at 220. What is Veronica's call in terms of the continued cutting narrative from the Federal Reserve? This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manish Krenny. Let's set your agenda. Caution ahead of the last piece of the jobs jigsaw for 2024, guiding the Fed's rate cut options. President-elect Trump picks David Sacks as his AI and crypto czar. along with former Senator David Perdue as ambassador to China. And our exclusive conversation with the Bank of England, Swati Dhingra, coming up. Markets are cautious. They're a little bit nervous ahead of the jobs report. 220,000 is the consensus estimate. We're flat on stocks. Bank of America warned there's a bit of a froth building in these markets. There's a risk you could overshoot, but they still see you getting to 6,666, 10% higher than here. Roll it over, have a look at the bond market. Ground zero for the reaction function, really, on the jobs report. Average hourly earnings, 3.9%. Our wages getting a little bit tighter. We're ticking up by 1 basis point this morning. Still, the market sees a 65% probability of a 25 basis point cut in December 2025. That is a different story. We're 3 hours away from that November payrolls report. Nella Richardson of Automatic Data Processing weighed in on the debate.
I think there's going to be two head fakes. One was in October, when we saw that really small number because of strikes and hurricanes from the BLS. The second head fake will be tomorrow. You're going to see a bounce back that won't tell the whole story of the labor market. The story of the labor market is that we're in a quiet period. There's not a lot of layoffs and there's not a lot of hiring. We're in this kind of stasis period. How long that quiet period lasts is undetermined. And what triggers it and which way, whether it goes up or down, still undetermined. So yeah, we're in a messy spot.
We're in a messy spot. There you go on the data. There's a shocking headline. Veronica Clark is the US economist for Citi. Veronica, good to see you this morning. I think that's an interesting kind of take. You know, number of head fakes. We're in a messy space. Your biggest concern is this, is that the summer lull returns. You're not that optimistic about today's non-farm payrolls, are you?
Yeah, no, we're not. I mean, there is a lot of messiness to this data, absolutely. And that's why it's important not to read too much into any 1 or 2 months of data and really look at the trend. And we are trying to pick out that signal from all the noise. And it looks to us like the trend is still for a weakening labor market. And we've seen that for well over a year at this point. You know, we had the unemployment rate rising from a low of, 3.4% to 4.3% over the summer. A couple months of stability isn't enough to convince me that that trend is not still weakening.
So what do you say differently to Jay Powell? Jay Powell says this economy is stronger than he thought it was in September. This economy is the envy of the world. You are disagreeing with the chairman.
Yeah, I mean, I think it's more, do you believe this level of activity or do you believe the trend? And what is a trend if not how the level of activity is changing? And certainly the employment, picture is going to be most important for the Fed. I think when Chair Powell talks about the data looking stronger, he's talking about some big revisions that we had to GDP growth, which is true. But okay, GDP growth was even stronger than we thought and the labor market still weakened. So
what do we go into in this jobs market? Is it a form of churn? Is it a form of turnover? Is it about downsizing? If growth is strong, you don't necessarily need to downsize, but you may need to re-engineer.
Yeah, so I think everyone agrees on what we're seeing in the labor market, which is this very low churn environment where there's very low hiring. There aren't layoffs yet. You're not laying off people, but layoffs happen even in a healthy economy. Yeah. And if hiring is as low as it is, you would be biased to think those people are not going to be quickly finding jobs. The unemployment rate is just still rising, and that's what we've seen. The rising unemployment rate is fundamentally demand for workers not keeping up with labor supply.
So the risk is that the unemployment rate begins to tick higher towards 4.3% again. And that is a bigger red flag for the Fed, perhaps.
Yeah, absolutely. That's our forecast for today's number. We think we'll see a 4.3% unemployment rate again. That unemployment rate, there are a lot of issues in the payrolls data, the strikes and hurricanes. Yep. I think everyone knows that. That unemployment rate should be relatively clean of those effects. And it did rise, not on a rounded basis, but on an unrounded basis in October. So we are looking for that to increase again. So
what does that do to your call, which was originally 50 basis points for December? Are you still hanging on with fingernails to that? Or is that, no, Manus, there's a more realistic moment to review?
We'll see today's data, of course. But I do think the bar for them to be cutting in December, at least 25, is pretty low. Even if we get a very strong number today, I don't think that's enough to deter them. I think it would be more CPI next week. We'll see what we get there. Do you need to break 300,000 to recalibrate a cut in December? Is that the kind of boundary? I would think so, because there is this noisiness to the data, right? Is it going to be strikes and hurricanes? You can kind of look through that. The unemployment rate, I think, is the most important part of this number. But I really think it would only be surprisingly strong inflation next week, or CPI next week, that would do it.
Just had a conversation with Deutsche Bank, and they are saying you're going to get growthflation in 2025. Do you share? You don't share that kind of viewpoint, but then this comes back to: are you at odds with the market in terms of the scale of cuts that you're going to get in 2025?
Yeah, absolutely. I mean, obviously, we'll be very data dependent, just like the Fed will. And it's the employment data and the inflation data that matters most. But I do think, at least in the next 6 to 9 months, and we can question how policy, incoming policies will impact the data later. But I think that's really second half of the year. But the first half of the year, there are a lot of reasons to think inflation is slowing. The labor market is loosening. We don't see pressures in home prices yet. Energy costs coming down, PMI prices are lower. So there are reasons to be encouraged that inflation is slowing.
And the consequence of all of that will have a knock-on effect on wages. If you think there's an incremental rise in unemployment rate going to 4.3%, what does that do to the wage situation?
Yeah, I mean, I think that wage pressure has slowed a lot, and that is evidence the labor market's loosened. We had a couple weeks ago the Q3 employment cost index reading. That's the Fed's preferred measure of wage growth. It looked pretty normal. It was the first print in a while that kind of looked like it could belong in 2019.
Let's pivot for a moment. We just finished a conversation with the German finance minister. Everybody's trying to work out how to deal with President-elect Donald Trump. Trudeau got on a plane, he came down. Strangely enough, you are the chief economist for Canada. Yeah. I was looking at some of the BI research. Walmart, Kroger, Albertson, and all the grocers and potash makers would see their costs rise by 25% if we had the extreme of 25% tariff on goods from Canada. You don't see that actually happening, but that is your risk to all of your models next year, isn't it? It's the boomerang inflation.
Yeah, no, absolutely. I mean, all of those, all the tariff threats, not just for Canada, but, globally, are a really big uncertainty unknown right now. Certainly, tariffs would raise price level. Maybe if they're, to a large enough degree, it could become more actual inflationary. Inflation expectations would rise. And yeah, I'm not expecting to see 25% tariffs on Canada. I think there will be ways that we can avoid that. Do
you think Trudeau gets big carve-outs?
I do think,
I presume oil is going to be a carve-out on the whole trade.
Yeah, absolutely. Obviously, the U.S. imports a lot of Canadian oil, and that would mean higher gas prices potentially. I don't think that would necessarily happen. We would get some of those carve-outs.
Tell me this: who's playing the sharpest game so far? Do you think Trudeau getting on a plane or Scheinbaum, sending out messages?
I don't know. I'm not a political strategist on any means. I will let them do that.
Let them play out.
Yeah.
Okay, Veronica, great to see you. Let's see what the jobs report is. Veronica Clark there at 155,000 on the jobs report from Citi. The consensus is 220,000. Coming up, we have an exclusive conversation with the Bank of England MPC External Member, Swati Dhingra. That is up next on Bloomberg Brief. It is your Bloomberg Brief. I'm Manus Craney here in New York. The Bank of England is heading into its quiet period before the last meeting of the year. Bloomberg's Lizzie Burden is sitting down with the MPC External Member in London for an exclusive conversation. Lizzie, good morning.
Manus, thank you. Yes, I'm delighted to be joined by Swati Dhingra, the resident trade expert on the Bank of England's Monetary Policy Committee. So what a good time to talk to you. Thanks so much, Swati, for stopping by. Your colleague Megan Green said yesterday that Britain might end up having to choose between the US and the EU in a tariff Trump war. As the trade expert on the BOE, I wonder which one you'd pick.
I think we should do things that suit us economically the most. And that doesn't have to be picking sides always. Sometimes it's a matter of optimizing both. Broadly, though, I think this is going to be a really important moment for Britain to cooperate with other nations if the US is going to put up trade barriers and there's going to be retaliatory action from everyone else. I think this is a really important moment to ensure that happens, if it does happen, that it's an orderly fragmentation and not a disorderly fragmentation, because that would be bad for all of us, not just sort of Britain.
But I mean, in a world where Donald Trump's threatening the EU with tariffs, is this actually a moment where Brexit pays a dividend, that the UK can set its own trade policy?
We can set our own trade policy, but we're still very constrained by the kinds of policies that can be put in place. If suppose they start having factor content requirements about where you source your goods from, where you source your services from, then we're in the same position as many of the other nations. And in that sense, we don't have that much of an advantage about doing independent trade policy. That being said, I think this is going to be a testing moment for how well we can do our own trade policy. But we've got to remember that the way trade negotiations work, large trade partners tend to have much more bargaining power than small trade partners. And that's something we have to face up to.
I mean, even the CBI just this morning said if the UK engages in this tit for tat and strikes back with 10% retaliatory tariffs, it would barely budge UK growth and inflation. Do you agree with that analysis?
I think broadly the analysis is right that the direct exposure that we have to the US economy or to other parts that would be affected by the trade war is limited. But that's only the direct exposure. The indirect exposure, the macro effects that would play out, we are just as subject to it as any other nation. So just to give you an example, suppose the US does put on very high tariffs on certain products. That's going to put pressure on, say, the Chinese exporters or other exporters that are targeted by them to possibly lower their prices. In principle, we could be beneficiaries of that in terms of lower prices, but equally, if all of us start rushing to the same alternative exporters, if we want to move away from, say, Chinese exporters supplying us those products, then we all end up basically crowding to one source of supply, and we could end up in very much the same kind of world that we've seen in the past few years of supply chain disruptions.
But, I mean, if you do see that diversion of cheap Chinese goods, doesn't that make your job easier? Would it mean more rate cuts next year from the BOE?
I think it might also come at a pretty substantial productivity loss. And in that case, I think, expecting businesses to rewire so quickly to a new world, that's asking a lot, thinking that that isn't going to impact productivity. So I don't think it necessarily is going to make my job easier. It might make my job easier for a month or 2 months, but not necessarily over a 2 or 3 year horizon.
So thinking about rate cuts next year, Andrew Bailey, the governor, said there'll be 4 quarter-point cuts if the forecast plays out. How many do you expect are going to be needed?
So my policy view has been that, gradual is good on most occasions for the reason that, unless there's some big shock happening, say the pandemic hits and you have to immediately rewire your monetary policy strategy, most of the times gradual is better because it gives people certainty to plan ahead.
But so not all the time?
Not all the time. There are shocks which come, and most of the decisions that we make, have to react to those very sudden shocks quite quickly. But the rest of the time, how much information gets revealed about the economy in a month is very limited. Most of the economic indicators that we look at are slow moving. Also, most of what we do in terms of our monetary policy actions takes time to have effect. So why would we do sudden changes as opposed to moving gradually and learning slowly and steadily about the economy? In my view, I think we have a very restrictive stance at the moment. That's weighing on living standards. That's weighing on even supply capacity and investments. And that's why we need to sort of start to take that away to some degree so that we start to get normalization back into the economy.
Yeah, I mean, if rate cuts are too gradual, would that be a policy error? Do you risk harming UK growth unnecessarily?
I think that's always been the biggest challenge that we've faced. We're not dealing with a situation where we think the economy is going to keep growing even if we have a restrictive stance. In this case, we're really sort of paying a price in terms of, consumption's been very weak. Businesses have been telling us for months that they've reduced investment for the reason, the broader macro outlook, as well as for the fact that it's becoming more expensive to finance those investments. So it's a combination of all of those factors, the weak consumption, the weak investment, and possible damage to supply capacity is what I would worry about, and that's why I think we should be easing policy more.
I'm kind of wondering, if you look back, do you think that the BOE didn't have to put rates so high to get inflation to target then?
So I think one way of thinking about that question is what happened in June 2023. Almost everybody was labeling the UK as an outlier. But if you looked more carefully at some of the other indicators, which are more indicative of pipeline cost pressures, like what are producers paying for buying from each other, or what are they paying for inputs, those numbers were in some cases even in negative territory. So those pipeline cost pressures, there was indication that they would start to ease, and we did see that happen. So by the time we got to November, we were saying that inflation was going to be now at about 3% or 3.4% if you went with the mean forecast. at a rate of about 5% on bank rate. But that's not the world we're in now. We've actually seen wage pressures come down. We've seen services continuing to ease, albeit slowly, because these are slow-moving indicators. But broadly speaking, we are almost at half the point that we thought we would be at. So, bank rate has to ease as a result. Both of those things can't be consistent with each other.
In terms of the end point, the Fed and the ECB are having this big debate about the neutral rate. It seems, at least to some former BOE policymakers, to be something suppressed here in the UK. Where do you see the neutral rate for the Bank of England?
So I don't have particular reasons to disagree with the central view that most, say, forecasters, most market participants would take, which is somewhere in the range of 2.5% to 3.5%, with pretty large error bands to these things. Given those large error bands, I think it's very hard on a day-to-day basis when interest rates, have been at about 4.5-5% range to say that somehow we can take real serious indication from that neutral rate to set policy today. We're quite far away from that, so in that sense, it's not very informative of what I need to do tomorrow. But broadly speaking, I think the compelling arguments that I've heard about why the neutral rate would have risen are the ones around artificial intelligence, about need for greater public investment. I think those are plausible stories, but to a large degree, that's not where the reality of the UK is. That might be more true for the US, where we have seen AI boom much more than, say, in the UK. But at the end of the day, on a longer run sort of view, we're a small open economy. What happens in the US matters to us. So in that sense, I'm willing to buy the argument that the neutral rate has risen to some degree.
All right, Swati Dhingra, thank you so much for making time for us today ahead of that December meeting. Manus, back to you.
Lizzie, thank you. Great conversation. The debate is, of course, is high tide our rates. And in that conversation, she says rates are tight. It's the same debate here in the United States of America. Coming up, we discuss what to expect from, you got it, the jobs report, the last one of 2024, the guiding North Star for the Federal Reserve FOMC's rate decision in December. This is Bloomberg. Good morning. It is your Bloomberg Brief on Jobs Day. I'm Manus Cranny in New York. What have we got for you? It is the main event. 8:30 a.m., the jobs report will hit the tape. The surveillance team will take you through those. Then some economic data from the University of Michigan, the Consumer Sentiment Survey, 10 a.m. And it's a big day for Fed speak as well. Bowman, Daly, Goolsby and Hammock all on deck post-jobs. So that is going to be interesting to see what their take is. Mike McKee is with me pre-jobs, post-jobs and throughout the day. Good morning. The whisper number is now inched lower to 217. How much distortion is there in this non-farm payroll number? Because we've got ex-hurricanes, we've got strikers coming back. How distorted is this number going to be today?
Well, this number won't be as distorted as October, but because of October's distortions, it's going to be harder to read. We know there are about 38,000 jobs that were subtracted from manufacturing, largely because of the strikes against Boeing. So we can estimate that. And here are some numbers on what we are looking at least from the BLS, in terms of what we saw in job losses state by state. Now, the surveys are a little different, so you can't add them up and say this is exactly what it's going to be. But you can see sort of the impact that we're expecting. And it may not be from the hurricanes as bad as people anticipated. So we don't really know where we're going to come out, which is why the Fed is going to kind of ignore this headline number and look at unemployment instead.
And therein lies the point. I just had Veronica Clark from Citi in the seat. She's going for 4.3%. She says it's a slow dissipation in this economy and that the unemployment rate will rise to around 4.3%. But you sat in the seat and said, actually, that's not going to be that far from what the summary of economic projections were in September. So the trajectory is for rising unemployment.
The trajectory, at least according to the Fed, is for rising unemployment, and they've been surprised by the fact that it hasn't really gone up. In September, they predicted 4.4% by the end of the year. Now, that was September. We get in 2 weeks a new estimate. We'll see what that estimate turns out to be. But at this point, we're seeing unemployment better than they anticipated, so a little bit of a rise isn't going to bother them. Now, we're pretty evenly divided. Veronica's more on the high end.
She is.
We're pretty evenly divided among economists who say 4.2 or 4.1, and the difference really comes down to rounding in that 3 digits that we look at as economic nerds.
I mean, that I wouldn't be so self-flagellating. I mean, that's pretty tough, though. That just shows you how nuanced this forecasting is for the Fed if we're down to 3-digit rounding, both on PCE and on the unemployment numbers.
Well, the hard part is that we're looking for some sort of signal on the economy. Yeah. And when you're looking at 3 digits, you're not getting a very strong signal one way or another. And I was talking to a senior Fed official this week who basically said, even 4.2, 4.3, we are still in the range or below the range of full employment. So we're not really worried about that. It would take a sharp move in unemployment for them to start thinking that the labor market is weakening significantly.
Okay, Mike, well, we'll see what the numbers are when they hit the tape in just a little while, and you and the surveillance team will take us through all of that. It's Mike McKee on the jobs report. Some individual stocks, keep an eye on these. Ultra Beauty is extending its post-earnings surge. Strong sales, despite the analysts' previous concerns that the firm began the holiday discounts a little bit too early. You can never start too early with the discounts. Lululemon is continuing the gains, boosting the full-year outlook as the oversales, they blunted the US softness. And Palantir signs of a new partnership with Shield AI to develop AI-powered autonomous military aircraft. Just had a conversation with the German finance minister again, all around how do you build funds to assure the industry, the military industry, to continue to build. Those are the individual names. We're going to be all eyes down on the jobs report, as Mike says. What is the effect going to be? Here's your FX board for the moment. Again, sub 200,000. It's going to be seen as a reasonably weak number, but we are very long of the dollar. Positioning is quite extreme. Sterling, keep an eye on at 127.60. We just had Bank of America, a huge call from Bank of America. By the end of 2025, you're looking at 138 on cable and 80 to the euro, the strongest since the Brexit vote. The Trump tariffs could push the UK to actually do more with Europe. Dollar yen, well, of course, if there's a little bit of a shift in the jobs report and a strong dollar, you could say hello to 151. Surveillance is up next. That's it for the brief, team.